Hi, welcome to another episode of Investment Bank Trading Strategy. In this series, we'll walk you through all the popular trading strategies among investment bank traders. Without further ado, let's get into it. Today, we'll talk about one of the most commonly used option trading strategies, the bull and bear spread. Let's start with the definition. What are bull and bear spreads? A bull spread is an optimistic option strategy designed to profit from a moderate rise in the price of a security or asset. A bear spread is the opposite, which is an option strategy used when one is mildly bearish and wants to maximize profit while minimize cost. Let's first talk about a bull spread strategy. A bull spread involves buying and selling either calls or puts with different strike price but with the same maturity. The lower strike is bought and the higher strike is sold. If you do it with calls, then it's called bull call spread. If you do it with puts, then it's called bull put spreads. Now we have the payoff diagram of a bull call spread. Note, the payoff and maturity for bull call spread and bull put spread are the same. So we'll use bull call spread to demonstrate the features of bull spreads because it's more intuitive. We can see that the upside is limited. That is because we sold the higher strike call. And the downside is limited because the most we can lose is the premium. Let's look at a real life example to help you better understand the bull call spread strategy. This is a screenshot that I took from Yahoo Finance. It shows the spot price for SPY, an S&P 500 index ETF, and its call option chain. For this example, let's say that I think SPY will reach $430 per share around mid-September 2021. Now, how do I trade based on my expectation? I could buy call option or use the bull call spread strategy. For simplicity, let's compare the following two strategies. First, long September 17th, 2021 call with a strike price of 420. And second, a bull call spread strategy with longing the September 17th 420 call and shorting September 17th 430 call, which are the two highlighted options on the screen. Now, let's fast forward to September 17, 2021, which is the maturity date of these options. If my forecast is correct, SPY closed at $430 per share. Then the return for my bull call spread strategy is 89%, but the long call strategy will yield a negative 25% return. That is because the cost of bull call spread strategy is lower than long call strategy because we've sold a call with a higher strike to offset the cost. If the close price for SPY on the maturity date is below my target price of $430, then my bull spread strategy will lose less than the long call strategy because the cost for bull spreads is lower than the long call. But on the other hand, if the close price is above my target price $430 on the maturity date, then the long call strategy has the potential to make more money than the bull spreads because bull spreads has put a cap on its profit by selling a higher strike call. Next, let's move on to bear spread strategies. Bear spread is the opposite of bull spread, where you purchase and sell of either calls or puts with different strike price but within the same maturity and underlying asset. The highest strike is bought and the lower strike is sold. Here's the payoff diagram for bear put spreads. Again, the payoff and maturity for bear put spreads and bear call spreads are the same. So we're just going to look at bear put spreads for illustration. As you can see, the payoff diagram for bear put spreads is identical to bull call spreads, but flipped. Let's use the same example, but this time my target price for SPY is going to drop to $410 per share around mid-September. So to trade based on my forecast, I can either long put or use the bear put spread. Let's compare the return of long September 17, 2021 put with a strike of 420 and bear put spread with longing September 17 put with a strike of 420 and shorting September 17th put with a strike of 410, which are the highlighted options on the screen. On the maturity date, if my forecast is correct, my bear put spread yields a 196% return, where my long put only yields a negative 35%. This is because the same reason. The cost for bear put spreads is lower than long put. But if SPY drops lower than my expected price, 410, long put can make more money because bear spread has a cap on its profit. But if the close price stays above my target price, 410, then bear spreads will lose less than long put because, again, the cost is lower. Why is this strategy so popular among investment bank traders? Because it has a lower risk. Believe it or not, investment bank actually has a lower risk tolerance than most retail investors. But their cost of fund is also much cheaper than retail investors, so they can still have a juicy profit margin. These two screenshots are from my brokerage. They show the Greeks of the two option contracts in our bull call spread example. We can see that if I long the contract on the left and short the contract on the right, most of the risk, or the Greeks, are neutralized, only with a little bit of delta exposure left. That's what I mean by lower risk. If you want to learn more about Greeks and option pricing, please check out our videos on option pricing. If you have any questions on this topic or have anything that you want us to talk about in our future videos, please leave a comment down below. If you enjoyed our videos, please subscribe and smash the like button. You can also follow us on Twitter or visit our website at www.ironhawkresearch.com. We'll be posting weekly market commentary and article about things that you might want to know in finance. Thank you very much for watching and see you next time.